Did you know there's a strategy for taking advantage of those losses in your portfolio? Things are down and you want to generate some tax deductions, but you don't want to give up on the upside potential to watch that position rebound. Well, we're going to share with you exactly how to do that in just a moment. What's up, y'all? I'm here today with my good friend and co-host for these Friday editions of the podcast. Got Marshall Johnson here with me.
Hey, what's up, good buddy?
Yeah, man, it's an exciting time. It's an exciting time to have a conversation with you, as it always is every single Friday, because this is our opportunity to spotlight one of our favorite articles. We sift through all these articles all week. And I got to say, there were some great articles this week. It was difficult to pare it down to one. Yes. And we were able to pare it down. We really were between three right now for what we're about to spotlight for you. However, we did dial it down to one that we think is probably the most timely of the articles that'll help you make best decisions right now with your life savings. And that's what Weekend Reading's all about. Mm-hmm. It's one email that hits your inbox every single Friday, 4 articles on trending topics in the financial planning space, all designed to help you make better decisions about your finances. It could be the latest in tax loss harvesting strategies, which is what we're going to focus on today. It could be the latest in income strategies, investment strategies, or maybe the latest research in the softer sides of retirement. And we will also provide you all kinds of cool opportunities to get involved in webinars and special events, book giveaways, white papers, so much more. All you have to do is go to retirewithpurpose.com. First name and email will get you signed up, or you can just text us at 866-482-9559. Just text us WR and we will send you the link to get yourself signed up. So we're going to be focusing on an article from Barron's, and it is titled, "Now's a Good Time to Focus on Tax Loss Harvesting, and Here Are 7 Tips."
You know, the market's dipping, right, when the tax loss harvesting articles start popping up again. But it's a great topic, and I think it needs a little more explanation, right? Most people have heard of the concept, but what is it? How can it benefit me? It's almost like trying to make lemonade out of those lemons.
Yeah, there's a lot of good stuff in here. And to your point, Marshall, this can be fairly complex. I think a lot of the articles that I'll read around tax loss harvesting, they leave out some of the missteps, some of the mistakes that are commonly made quite often by do-it-yourselfers that don't know every single one of the rules. And as we know, if there's a simple way to do something, an easy way to do something, and a hard way to do something, well, the IRS tends to make it a little bit more complex. And that's exactly what you're seeing here. But it is something for us to focus on when there's a lot of volatility in the markets. And hey, there's been a lot of volatility in the markets. You know, what tax loss harvesting really is a strategy to sell securities at a loss to offset your capital gains. And usually, I would say we're not often having this conversation on the radio, podcast, TV, webinars. You know, quite often we're not having this conversation till the end of the year. But every once in a while, I know we had this conversation back in March of 2020. Right. We're finding opportunities throughout the year to take advantage of a market sell-off and generate some tax losses that you can net out against your capital gains and a little bit against your ordinary income as well. And that's what we want to make sure we're focusing on, is not just looking at this one time a year, but we should be looking at this throughout the year, avoiding several traps and really focusing on best practices.
Yeah, you know, when the markets are topsy-turvy, like this article points out, topsy-turvy, you got to look for opportunities, and inaction is usually not the right response. Sometimes it can be, and this article explains that as well. But we have to realize what they're talking about. They're not talking about your retirement accounts or your IRAs or your Roth IRAs. We're talking about brokerage accounts or after-tax accounts where you can sell something at a loss. I get that question from clients all the time. Yeah. Maybe they bought a stock, maybe they bought Netflix at the end of last year in their IRA, and it's down 69, 70%. Well, they can't realize that loss and use it as a benefit in the future if it's inside of the IRA. Yeah. But that same client that had that question, I said, well, do you still believe in Netflix? He said, yeah, I think they'll come back. I said, well, convert it to a Roth. So looking for these opportunities,
Yeah.
convert it while it's down, pay the taxes on it while it's down. So there are things you can do inside of that IRA, but tax loss harvesting is not one of them.
Yeah, I don't understand. Everybody likes Netflix. Come on. Netflix isn't going anywhere. But we have to understand the limits as well. So your limit is this. You can net out your capital losses against your capital gains. Now, there's a limit to that, which is about $3,000 over that you can use to offset your ordinary income. And you also want to keep in mind that you can carry those things forward. So you can carry forward those losses indefinitely. But that means you're going to need some capital gains somewhere down the road in order to net those things out if it's very large. Because if it's a several $100,000 loss that you can't deduct, $3,000 against your ordinary income every year, I don't know exactly when that opportunity might come where you actually clean out those losses. And when it comes to the state rules are different. So you want to pay attention to the rules in your state to see if they allow carry forward losses whatsoever. And that's not all you need to watch out for. The biggest thing that you need to watch out for when you're taking advantage of harvesting some losses is the wash sale rule. And this is where most missteps are made.
Yeah, so we talk about the wash sale rule, and it's really understanding that the rule prohibits selling an investment for a loss and purchasing the same or substantially identical, that's in quotes, I love that, substantially identical investment 30 days before or after the sale.
Yeah, so let's go ahead and use a little example. So let's say that you bought 500 shares of XYZ Inc. Okay, so 500 shares of good old XYZ for $10,000, and then you sold them on November 5th for $3,000. So you generated a $7,000 loss. On November 29th, within 30 days of that sale, you bought back 500 shares of XYZ again for $3,200. Now, since the shares were bought back within 30 days of that sale, the wash sale rule applies, right? You bought back the same exact thing, not even substantially identical. It was identical. So you cannot claim that $7,000 loss. Not only that, your basis in those 500 shares is now higher than it was before. Now it's $10,200. The actual loss of $7,000 plus the extra $200 that you paid when you bought it back. So you're actually going to have a basis of $10,200. So this is what we want to avoid. Now, if you bought it back proportionately, so let's say that you bought back 300 of those 500 shares or 60% of those shares, you would be able to claim 40% of the loss on the sale or $2,800. The remaining $4,200 loss that's disallowed under the wash sale rule would be added to your cost of the 300 shares. So you can see this is something that can be a real problem. And think about what we just said. It prohibits selling an investment for a loss and purchasing the same or substantially identical investment for 30 days before or after the sale. Substantially identical, that sounds a little ambiguous.
Yeah. So the example they give here is you're not going to sell a Vanguard S&P 500 like a passive index fund. You're not going to sell a Vanguard S&P 500 and turn around and buy an iShares S&P 500. That would be substantially or thereabouts substantially identical. You're going to want to kind of go somewhere else. And there's where you've got some different types of strategies, right?
Yeah. Well, and let's say that you're selling, in that example, you're selling a passive index fund. So you're selling a large cap passive index fund, being the S&P 500 index fund. You could replace that with another large cap fund, but it could be an actively managed large cap fund, and that would work. That wouldn't be substantially identical enough in the IRS's definitions or guidelines. Then we have to watch out for dividends.
Yeah, the dividend piece was pretty interesting. I don't see this brought up in a lot of articles, but we're talking here about repurchasing the same security or substantially similar security 30 days after you sold it, but this also applies to 30 days before.
Yeah, so you want to make sure that you didn't receive a dividend within 30 days of that sale. Now, there's an advisor here in the article that says he advises this sale to be done a full business week in advance of a dividend payout or a capital gains distribution to be safe. And it's probably not that big a deal if you're selling the whole thing. If you're selling a small portion of a holding, then that dividend may potentially wash the whole thing away. So we want to pay attention to those dividend payouts as well. And usually when we're talking about this, historically, market's down, what are we selling? We're focusing on equities. We're probably focusing on your stock holdings, individual stock holdings, your mutual fund holdings, or your index fund holdings. Those tend to be the things you might focus on when you're trying to generate these losses. But today, boy, it's a little bit different. This has been a funky year so far.
Yeah, so you're gonna go to the get creative part here.
Well, I mean, talk about bonds.
Yeah,
right?
get creative. So historically, this has been something where you're focusing on your play account, your stock account, your brokerage account that you buy and trade stocks in. But think about it with bonds. We haven't had an environment where bonds have seen substantial losses like we've seen so far in calendar year 2022. So you may want to look at those individual bonds. You may want to look at those bond funds and try to decide, number one, your strategy going forward, but you can harvest those losses there. And it's a little bit easier to sell bonds, Casey. People don't get emotionally attached to their bonds very often, but they get emotionally attached to their stocks.
Well, it's a lot easier to sell a bond and replace it with something not substantially identical and have something that's pretty darn similar, right? So you could be selling one bond that's paying 3% at a loss and buying another bond that's paying 3% with those same funds and not have a wash sale because it'd be a completely different company.
Right.
So you may find it a little bit easier. I think individual bonds are where you're going to find a lot of those opportunities. However, today we are seeing a lot of very conservative fixed income funds that are seeing double-digit losses year to date.
Even treasuries, right? You look at treasuries being down the way that they are. But this is also something you mentioned that a lot of times this is an end of the year activity. The one market event that I can remember where this was back in March of 2020 when things really dropped. We saw a rush of tax loss harvesting at that time. But this may be an ongoing priority, right? Yeah. The markets may continue to be topsy-turvy. We may see run-ups. We may see tech bounce and run back up, or we may see some of these other sectors start to be erratic and have swings where they're up and down, a little bit of a roller coaster throughout the year.
Yeah, and what are we taught when it comes to investing in the stock market? Put the money in, don't look at it for 10 years. Right? Don't look at your statement for 10 years. Keep the emotion out of it. Keep the emotion out of it. Fantastic to be able to do that, but to not look at it for years on end, that doesn't make sense. I think it's not taking the motion out of it. It's not completely ignoring it. It's being disciplined in your approach, having a method of doing what you're doing. You just need to have a strategy. I was speaking to a CFA here recently from Retirement Researcher who's going to be coming on the podcast shortly. And he said it really doesn't matter what you're investing in as long as there's logic behind it. As long as you have there's good reasoning behind doing what you're doing. Now you have a reason to be more conservative or more aggressive or to exercise tax
or to sell
harvesting.
something, right?
Exactly. We just want to be disciplined with that approach. So when it comes to paying attention to these things, well, why not have a once a month check-in on your portfolio and this just be one of those boxes that you're checking? If you're doing your self-management, then check in on once a month and go, hey, should I be doing any tax loss harvesting? And we also need to have a strategy once you decide you are going to execute that. You need to have a disciplined strategy for what you're going to sell, what you're going to replace it with, if you're going to get back in and when.
Well, and I think that's what a lot of people are hearing when they hear this strategy. It's like, wait a minute, I'm going to sell when something's down. But if you're selling a position and you want to maintain, they go through this with this interim strategy. It's like you don't have to sit in cash for 30 days. You could sell an individual stock, say it's a large cap stock, and buy an S&P 500 index fund for 30 days or 31 days, and then turn around and repurchase the same stock you sold if it's still down, if it's still attractive.
Yeah, and we cannot possibly be doing this without putting it in writing, I believe. I think the practice has to be, okay, I am going to sell this today. I'm going to sell XYZ. I'm going to replace it with YYZ. And then I'm going to purchase back XYZ if it's at this price. If it's not at this price, I'm going to continue to hold where I currently have reallocated.
Yeah, so I've had this similar experience back in the fall of 2020 when a lot of the oil companies were just beat up through COVID. A lot of the broader market started to recover in the summer months, but the oil stocks were just pummeled. So back in November of 2020, I had a client that really loved his Exxon stock, but he wanted to sell it and realize some some losses, but he didn't want to go into anything else. He didn't want to take it to an index fund. He didn't want to have an interim strategy. I mean, if you thought about it, in November of 2020, oil stocks have been down for, most of the year. It didn't look like they were going to recover anytime soon. But what started to happen is the world started to open back up a little bit, and lo and behold, that stock was trading, let's say, $30 a share at some point in November, and pretty soon, 30 days later, it was up to $40 some a share. And he's like, I'm not ready to get back in at this price point. And then before we knew it, 3 months later, it's back up to $60 a share. So he never got back into that position. So you have to have a strategy.
There are some real risks in that. And I think that is the real risk, especially when you're selling an individual equity that may be down tremendously. It could be up tremendously in a very short period of time. And replacing that with an index fund may not allow for that same rebound or those same gains in the back end. And I think that really exemplifies the piece here in the article that says, make sure the sale makes sense. And quite often we want to let the tax tail wag the dog. People come in, they want to talk about taxes. They want to make tax a focus. And we go, hey, we don't have an income strategy yet, right? We don't even have an emergency fund yet. We don't have an estate plan yet. We don't have a strategy for healthcare yet. We need to make sure we have all our ducks in a row before we start focusing on taxes, or we can end up making mistakes. And this can be one of those mistakes. And one of those also is just, is it worth your time? How much time are you going to absorb in doing this? This is a huge piece of the way that I invest personally. I go, boy, is it worth my time to sit here and day trade crypto? Or is it worth my time to sit here and seek out the individual bond that's going to pay an extra 1% or the CD that's going to pay an extra 0.5%? I think you have to put a time to your actual value, your hourly time that you actually are going to put into this. How much is your time worth? And is the time you're going to put into this going to be worth it? And I think you also have to factor in the headspace that it's going to take up. Now you're going to be thinking about your holdings for the next 30 days and watching that stock every single day for the next 30 days. That may not be worth a couple $100 you're going to save on taxes. And to offer a little bit of an example, I've got an example here of selling an appreciated stock for a gain of $2,500. So you sell a stock for a gain of $2,500 and you don't sell any other stocks for a loss. Your gain's taxed at 20%. Say it's long-term capital gains, and you're in the 24% bracket. So you're going to pay $500 in taxes. So there's your tax bill, $500. Then you have a tax loss harvesting that strategy you're going to implement. And let's say you sell that appreciated stock for a gain of $2,500, same scenario, but then you sell a depreciated stock for a loss of $1,000. So you net a gain of $1,500, pay $300 in taxes. On Schwab's website here, they have this example explaining how this is such a great deal. And I'm going, well, I netted a gain of $1,500 and I saved $200 in taxes. So my net gain is $1,800. I don't know that was really, that didn't add any value really at the end of the day whatsoever. Now, maybe if I replace that depreciated stock that I sold at a loss with an index fund, I could say, okay, well, maybe I didn't really incur that loss. I still have a pretty good gain at the end of the day, saved a couple $100 on taxes, but still, I'm saving a couple $100 on taxes. Is that really worth our time? I think when you're going to execute this strategy, if you're going to do it on your own, you really have to pay attention to the amount of time and effort and headspace that it's going to take up. And this is why it makes a lot of sense to implement these kind of strategies with someone you're paying to do it, right? You're paying an advisor to manage this portfolio and execute these things on an ongoing basis. It may not take up any headspace if you let them just execute those things and reach out to you when there's something that's fairly substantial. And maybe you put some benchmarks in place for that. You do it with a robo-advice firm, you're never going to get a call. And that may be irritating for you, that no one's ever going to call you and say, hey, we're selling this, we're replacing with this.
With some of the tax alpha strategies is what you're referring to.
We have some clients that we work with that are just on autopilot with this strategy and let us execute it on an ongoing basis. But most of the time, they don't really want us to be doing these things, especially when we're talking about about a fairly substantial opportunity without actually picking up the phone and having a conversation about it, especially if they're emotionally attached, which often happens in these positions, because if it's fairly substantial, you've probably held on to it for quite some time.
Yeah, and I think it's opportunistic, right? If we sold a bunch of tech stocks at the end of or the beginning of this year, we had a bunch of capital gains. Well, then the rest of the year, look for those opportunities, right? If you're in a situation where your income's a little higher than you want it to be, and you have some losses, and you want to try and bring down income a little bit at the end of the year, then look for those opportunities. Be aware of the situation. Counsel with your CPA, your tax advisor as well. If you're a do-it-yourself investor and you do your own taxes, just tread carefully.
Well, and I want to throw this last little bit out there in case someone's thinking, well, you know what I'll do? I've got an IRA. I've got this other account over here. I've got this business entity account. I'll just sell it here and buy it back over here. Mm-hmm. That's probably the most common mistake that you see is someone that's selling a share in a taxable account, buying it back into an IRA or a spouse's account or a business account.
Yeah, spouse's account's a big one. Well, I'll just sell it in my IRA or sell it in my brokerage account, buy it in my wife's.
Exactly. So we want to make sure we have a plan. We're disciplined, that it's actually worth your time at the end of the day. And make sure you understand all the ins and outs. Talk to your CPA if it's a fairly complicated situation or it's a pretty large loss or gain for that matter that you're looking at. I think it always makes sense to incorporate a CPA into your financial planning team to make sure there's nothing falling through the cracks.